Hey everyone, this is Matt with the Fundamental Investing Institute. Thank you for tuning in. We're going to make a video today on the Jobs Act and to talk about a term that I use a lot called mainstream investing. And when I say mainstream investing, I'm really talking about passively investing in the equity and or debt of private businesses and real estate assets. And when I say passive, I mean someone is passive when they are not actively involved in day-to-day management and when they are generally a minority holder of the equity position in the business or the asset. And over the last several years, there have been a lot of opportunities for everyday investors to participate in these mainstream assets. And the biggest channel for everyday investors to invest in private businesses and real estate assets is the Jobs Act. The Jobs Act, that stands for Jumpstart, our Business Startups Act. That was legislation passed in 2012, and it went into effect starting the next year. Certain provisions of it starting the next year in 2013 and then later in 2016. And there are three channels of the Jobs Act that are most important to investors and to businesses and to equity sponsors that are looking to raise capital. And one section of the Jobs Act is Title II. And what Title II did is it lifted the moratorium on general solicitation. So prior to the Jobs Act, if you wanted to do a private placement, you wanted to raise equity or debt in a way in which the placement was not registered with the SEC. So the SEC registration is very costly and it's very onerous. So anyone who is looking to do a private placement, they're starting an investment fund, or they're looking to sell shares in a business, they could not advertise. They had to have a pre-existing relationship with those investors. And that made it very difficult for a lot of entrepreneurs and fund managers and real estate sponsors and others to raise capital, because unless you had a big network, a big professional and personal network, became very difficult to meet investors. And the other issue is your investors generally, there was some exception to this, but your investors had to be accredited investors. The term accredited investor, there are a couple of different layers of that definition, but the most prevalent are the net worth requirements and the income requirements. So the SEC defines the certain level of net worth that an investor has to have in order to be accredited, and the SEC defines a certain level of income that investors have to be accredited. And so prior to the Jobs Act, you had to basically know high net worth, high income people. You had to have a pre-existing relationship. You couldn't advertise. And Title II of the Jobs Act created an exception in the Securities Act called Regulation 506C. And this allowed someone to advertise through whatever channels they wanted to use, but a lot of this is online. And they could do one of these 506C offerings, and there were two conditions. One is every investor has to be accredited, so they have to meet the net worth and income requirements of the as the SEC defines them. And the second thing is the sponsor, the firm that's actually raising the money, they have to verify the accredited investor status. So before, if you did a private placement, your investors could just, it was called a check the box provision. They essentially could declare themselves accredited, and the sponsor didn't have to do too much work. Now the sponsor has to verify the accredited investor status, and now there's some third parties that can help do that. They can help a sponsor make sure that the investors are accredited. But Title II, these 506C offerings, they're only available to accredited investors. Now, the more interesting channels of the Jobs Act are Title III and Title 4. Now, Title 3, this is called Regulation CF. This is crowdfunding. This is what most people think about when they think about crowdfunding. And these are broker-dealer or SEC registered investment portals online. So one of them is, I think Yield Street's one of them. Realty Mogul is another. There's a lot of different ones. They're registered with the SEC and they're registered with FINRA. FINRA is a regulatory authority, and it's a platform for allowing entrepreneurs to raise capital under this regulation CF. And as of right now, there's a cap on how much you can raise under regulation CF. I think it's $5 million, but you can target non-accredited investors, so it's available to anybody. There are limits on how much a non-accredited investor can put into these deals, but you can invest as a non-accredited investor or an accredited investor. It's available to anybody. You can invest through one of these portals, and they have a lot of different real estate deals and businesses that are looking to grow. There's a lot of different channels. So it's interesting because it's created channels for non-accredited investors to invest in private businesses and to invest in private real estate assets. Now, Title 4 is even more interesting in a lot of ways. It's called, it created something called Regulation A+. There was a previous Regulation A that was kind of dormant under the Securities Act. It wasn't used very much. This Title 4 of the Jobs Act, the SEC created what they call Regulation A+, and this allows firms to create a much bigger investment platform with non-accredited investors. Now, there are limits. There's two tiers to Regulation A+. The Tier 2 allows, I think it's up to $75 million now. So you can do big offerings. Now, there's two firms that are doing this. There's a lot of firms doing this, but two that I know of. I've looked at their SEC filings. One is Cardone Capital. So Grant Cardone launched Cardone Capital, and they mostly do these Regulation A+ offerings. These are real estate funds, and he can advertise to non-accredited investors. And Cardone Capital has raised hundreds of millions of equity capital, maybe billions, I don't know. And then another one that I know of is Realty Mogul. Realty Mogul is a crowdfunding business that offers proprietary funds. So they also have investment funds. And you can raise a lot of money with one of these Regulation A+ offerings. But the point of this video, to wrap it up, is that the Jobs Act has created these channels for everyday investors to invest, and it's really opened the world of private investing up to more people. So it's great. We look forward to seeing it grow and participating in it. So thanks for tuning in. We'll see you next time.